Hello guys, hello everyone. Welcome to Infinite Floating Stocks. I am Venkat and in this session I'm going to talk about option Greeks. Okay? I repeat, in this session let's discuss about option Greeks. Okay? So I'm expecting that you guys don't know anything about option Greeks till now. So I guarantee you a very productive session so that you'll directly get all the details about option Greeks in very simpler manner. Okay, you'll get to understand all about option Greeks and different types of option Greeks and how to use them, when to use them, and why do we need to analyze option Greeks before choosing a strike price. I'll be explaining everything in detail. Okay, so just pay attention and just pay attention and listen to this session. You'll get everything at the end of before the end of the session. Okay, all right, let's start. All right, these are the contents for today's session. So I'll be talking about what are option Greeks and what are different types of option Greeks and what is an expiry. Now I'll be talking about, I'll be explaining about expiry in detail. Okay, so I'll talk about expiry as well. So what are option Greeks? Simple. Let's look at formal definition of option Greeks. Okay, so option Greek is a term used in options market to describe how the premium moves. I'm expecting that you guys already know what is a premium. Okay, premium is nothing but it's a token amount or an advanced amount which you will be paying to get the right to enter the options contract. You need to be paying the premium. Okay, you already know what is a premium. So Greek is nothing but it is a term which is used in options market to describe how the price moves. Okay, how the premium moves. Greek is a term which is used in the option market, which describe how the premium moves. Okay, so and also it also tells about how the premium gets affected with the change in Greeks. I'm I know most of the people are not understanding what are Greeks, what are you talking, man. Okay, no problem, you'll get everything. Once we start moving to other slides, you'll get everything. Okay, what are different types of Greeks and how they affect the premium. Okay, just remember one thing, that Greek is nothing but there are five types of Greeks which affect movement in premium. Okay, so option Greek is nothing but it's a term used in option market to describe how the premium moves and how the premium gets affected with the change in Greeks. Okay, and these variables are called Greeks because they are associated with Greek symbol. Okay, Greek symbol. There are five different types of Greeks, and each Greek has different symbol, and those symbols are related to Greek. So we call they as option Greeks. Okay, it's that simple. So what are different types of option Greeks? So there are five different types of option Greeks, not five, six. Okay, there are six different types of option Greeks, and the first one is delta. Second one is gamma. Third one is vega. Fourth one is theta. Fifth one is rho. And sixth one is VIX or IV. I repeat, there are six different types of option Greeks. Among them, first one is delta. Second one is gamma. Third one is vega. Fourth one is theta. Fifth one is rho. And sixth one is IV. IV is nothing but impact volatility, or VIX. VIX is nothing but it's also volatility. Okay, so those are all. I have put the Greek symbols in brackets. Okay, those are Greek symbols. So we generally, when I say delta, you need to be imagining that symbol. When I talk about theta, and that means I'm talking about that symbol. Okay, you need to remember the symbols. It's not mandatory. Okay, no problem. No, not really necessary to remember the symbols. Okay, you just need to know the names of delta, gamma, vega, theta, rho, and IV. Okay, before choosing some strikes for trading, we need to look at delta, gamma, vega, theta, and rho also. Okay, yes, I'm gonna show a website where details of all these option Greeks are available. Okay, so we need to check details of. I mean, we need to check delta price, gamma price, vega price, theta price, and IV. Okay, we need to check all these things before selecting a strike price or before entering into a trade. Okay, so yes, let's talk about delta now. Okay, pretty simple. It's very simple. Delta is very simple. Okay, I keep it very simple. Let's look at the definition. Then I'll be explaining in my own terms so that you'll directly get into your heads without having any difficulties. Okay, so delta is nothing but delta is a ratio. Okay, sometimes referred to as hedged ratio that compares the change in price of underlying asset with change in price of derivative or option. I know no one understand. No one got the definition. No problem. I repeat. Delta is a ratio. Sometimes this is a formal definition. Delta is a ratio, or sometimes referred as hedged ratio, whatever it is, we don't care. That compares. Concentrate. Listen to this word. That the delta is nothing but that compares change in price of an underlying asset with change in price of derivative or option. Okay. So I'll be explaining this in next slide in very detail. Okay. Let's look at delta in simple words. Delta shows how much a price of premium can move depending upon underlying asset. So what is underlying asset? Underlying asset, underlying asset in our initial example, underlying asset is ticket price. I already explained you about ticket go. I mean, you planning with your friends to a Goa. Remember that example? Yes. All right. So in that example, underlying asset is ticket. In stock market example, underlying asset is Nifty or Bank Nifty or some other stock. Okay. So delta is nothing but delta shows how much price, how much a price of premium can move depending upon Nifty movement or Bank Nifty movement or stock price movement. I repeat, delta shows how much a price of premium can move. Premium is nothing but the token amount or an advanced amount which you have paid to enter into options contract. Okay, so delta shows that how much a price of premium can move depending upon Nifty movement or Bank Nifty movement or stock price movement which you have, the one which you have planned to trade. Okay, generally we call it underlying asset. Okay, all right. In simple words, this slide is very important. If you want to if you didn't understand previous slide, this slide is very important. You need to get everything which is written on this slide. Okay, this slide is very important and it tells this slide simplifies all about delta. Okay, so delta is nothing but imagine if delta is 0.20. Imagine that the value of delta is 0.20. Okay, then it indicates that movement of 100 rupees in Nifty or Bank Nifty gives only 20 rupees movement in the premium. Let's look at previous formula or definition. Look at this definition which I have written in a simple words. Okay, delta shows that how much a price of premium can move depending upon underlying asset. Okay, delta simply shows that how much a premium can move, okay, depending upon underlying asset. Now let's look at this line now. What I said, if delta is 0.20, then it indicates that movement of 100 rupees in Nifty or Bank Nifty gives only 20 rupees movement in the premium. Okay, imagine that premium is 100 rupees, it will move to 120 only if Nifty or Bank Nifty makes 100 rupees movement when delta is 0.20. Okay, I repeat, if delta is 0.20, that indicates, then that means movement of 100 rupees in Bank Nifty or Nifty will give only 20 rupees movement in the premium. Okay, so it's a simple mathematical calculation. There is no very difficult formulas involved in this to calculate to know about delta. Okay, pretty simple. Delta simply says that how much a premium can move depending upon Nifty or Bank Nifty or stock price movement, which is nothing but delta simply says that how much a premium can move depending upon underlying asset. Okay, let's look at another example. If the value of delta is 0.50, okay, that means when Nifty or Bank Nifty moves 100 points, premium of some strike moves 50 points. Why 50 points? Because delta is 0.50 here. Here the premium is in our first example, premium is moving only 20 points. Why? Because delta is 0.20. Okay, I repeat, when delta is 0.20, premium is moving only 20 points. When Nifty is moving 100 points. Okay, when delta is 0.50, premium is moving 50 points. Okay, when Nifty is moving 100 points. Okay, delta, if the value of delta is 0.50, that means Nifty or Bank Nifty moves 100 points. If if Nifty and Bank Nifty moves 100 points, then premium of some strike moves 50 points. Okay, so example, let's look at some example. If Nifty, imagine that Nifty moved from 12,500 to 12,600. How many points? It moved 100 points. Okay, now premium of strike 12,500 moves to 150 from 100 rupees. See, when you bought the when you bought the strike 12,500 by paying 100 rupees premium, it goes to 150. I mean, the premium went from 100 to 150 when Nifty moved from 12,500 to 12,600. Okay, this is all about delta. That's it. I repeat, when delta is 0.20, premium will move only 20 points. When underlying asset, which is nothing but Nifty or Bank Nifty, moves 100 points. When delta is 0.50, premium moves 50 points. When underlying asset, nothing but Nifty or Bank Nifty or stock, moves 100 points. Okay, so when delta is 0.20, premium will move 20 points. When delta is 0.50, premium will make a move of 50 points. When delta is 0.80, premium will move 80 points. When delta is 0.10, premium will move only 10 points. When delta is 0.70, premium will move 70 points. Okay, when delta is 0.90, premium will move 90 points. Okay, so it depends upon Bank Nifty or Nifty or stock, nothing but delta depends upon underlying asset movement. Okay, if Nifty is moving 100 points, at that point when delta is 0.20, premium will move 20 points, 20 rupees. Okay, if delta is 0.70, premium will move 70 points when underlying asset is moving 100 points. Okay, so just imagine this example. If Nifty moves 12,500 to 12,600, that means Nifty moved 100 points. Now imagine that at that time, the delta is at 0.50. Okay, then that means premium of strike price of 12,500 moves to 150 from 100 rupees. How much did the premium move here? It moved 50 points here. Why did it move 50 points? Because delta is 0.50 when Nifty is moving from 12,500 to 12,600. Okay, so this is all about delta. To check delta, you need to go to one website. Now I'm going to show that website. Okay, so sorry. So this is QuantSap. This is the website you need to refer for to check price of delta. Okay, for that you just simply go to Google and type QuantSap. Okay, and enter. Look at the spelling. It's QuantSap. QUANTSAPP. QuantSap. Just type QuantSap in Google. Click on enter. You'll get this first link which says that home QuantSap #1 options trading app. Click on that. Then select web application. You need to log in with Google. Okay, I have already logged in. So after logging in, this is how the screen looks like. Then you need to click on the top left banner. Then click on this chain. Okay, this chain. I repeat, after logging in with your Gmail, you need to click on top left banner. Then select chain, CHAIN, chain. Click on that. After clicking on that, select Nifty or Bank Nifty, whatever the strike price, which is nothing but underlying asset. Select that. Then you will get the strike prices, premiums, and also look, this is Gamma, this is Vega. Sorry, this is Vega, this is Theta, this is Delta. Okay, now see, look at. What's the price of delta? It's 0.49. Okay, so imagine that you have bought 14,150 call. Okay, so now after after some time the Nifty went to 14,250. Imagine that you have bought 14,150 call, and immediately after some time moved. Market was bullish, and imagine that it moved till 14,250. Okay, how much points did it move? It moved 100 points, right? From 150 to 14,250. Okay, in that time, uh, look at the premium. What's the premium here? 80 it is. Okay, so meanwhile your delta will be, because delta is 0.50, you will get to see 49 points movement in the premium. That means that this premium will become 80 plus 49, okay, which is nothing but 129. Okay, so imagine that you have bought a call at 14,150, and after some time imagine that market went till 14,250. Okay, because of that 100 points movement in Nifty, which is nothing but underlying asset, because of that your premium will move from 80 to 129. Okay, because it moved 49 points because delta is 0.29. Sorry, delta is 0.49. In our examples I considered 0.50 as delta, and I told that there will be a movement of 50 points in the premium. Okay, when delta is 0.50, here the delta is 0.4049. That means premium will move 49 points if Nifty moves 100 points. Okay, let's look at this delta. It's 0.14. Okay, so if Nifty moves 100 points, then this strike price will move only 14 points. Okay, so let's look at this example, 0.67. So if Nifty moves 100 points, then this premium, which is 145, will move 67 points because delta is 0.67. Let's look at this example. So if Nifty moves 100 points, then this premium, which is 56.4, will move 40 points because delta is 0.40. Okay, I hope you guys are very clear. I'm expecting that you guys are getting what delta is and how does it affect premium of chosen strike price. Okay, pretty simple. It's very simple. If Nifty moves 100 points, then if delta is 0.49, that means that premium will move 49 points. Okay, so it's that simple. Let's go back to the slides. So this is all about delta, and you need to check the value of all the option Greeks in Quants app web application. For that, you just need to go to Google, type in Quants app, click on first link, log in with your Gmail, then click on top left banner, come down and click on option chain, which is nothing but chain. Click on that chain, then you will get to see all the option Greek values. Okay, so if delta value is 0.70, and if Nifty moves 100 point, what happens? That means there will be a movement of 50 points. I mean, sorry, if delta is 0.70, premium will move 70 points. Okay, all right. So what is gamma? Gamma is very simple. See, gamma is nothing but gamma is a rate of change for an option delta. Okay, based on single point movement in delta's price. It's like gamma is nothing but, now what I told, option premium can be affected by delta. Okay, because if delta is high, option premium will move high. Will rise. Option premium will fall down if delta is small, if the value of delta is small. Imagine that if delta is 0.9, that means premium moves 90 points. Imagine that if delta is 0.10, then that means premium moves only 10 points. Okay, when underlying asset moves 100 points. Okay, so gamma is nothing but, it is rate of change for an option delta based on single point movement in delta price. Nothing but gamma affects delta's price. Delta affects premium's price. They are interdependent upon each other. It's pretty simple. Okay. I already explained you how delta how delta affects option premium. Okay. In the similar way, Gamma affects delta's price. Okay, so gamma is nothing but it is a rate of change for an option delta based on single point movement in delta's price. Okay, don't worry, I'll be explaining you in very simple terms. Okay, see, look at this simple definition. Gamma affects change in delta's price. That's it. Just remember what is written in simple words. Okay, gamma is nothing but gamma affects change in delta price. Okay, if del, I mean, d- mo- movement in the delta can be changed by gamma. Movement in premium can be changed by delta. It's like that. Okay, so gamma is at its highest when an option is at the money, and is at its lowest when it's farther from at the money. Okay, let's look at that. See, what is at the money? 14,150 is at the money because look where the Nifty has ended. Nifty is at 14,143. Okay, Nifty is at 14,143. Then that means 14,150 is at the money. With okay, this is at the money strike 14,150. Look at the value of gamma. Gamma value is 0.0019. Okay, now see, if I'm going down to 13,900, look at the value of delta gamma. It decreased 0.001. It's 0.001. Here it's 0.0019. Okay. If I'm coming down, look at the value 0.000. It's decreasing. Okay. So at the money, well, just look at this thing with what is written there, which is written there. Gamma is at its highest when an option is at the money. Okay, and it is lowest, and it will be lowest when it is farther from the at the money. Okay, so at the money is nothing but last traded price, and gamma will be highest at the money strikes, and it will be lowest if you move up or down. Okay, see, 14,150 is at the money. I'm moving upward. The value of gamma is decreasing. It came down to 0.0005. But it, look at the gamma value of at the money strike. It's 0.0019. See, now if I go down, look at the value 0.0002. Okay, it's decreased. So the value of the gamma will be highest at the money strike, and it will be lowest when you move upward or downward from at the money strike. Okay, so definition of delta is very simple. If delta is 0.20 and if underlying asset moves 100 points, that means premium moves 20 points. Okay, if delta is 0.90 and if underlying asset moves 100 points, that means premium moves 90 points. Okay, gamma is nothing but gamma affects change in delta price. Okay, and gamma will be highest at the money strike price, and gamma will be lowest when you move upward or downward from the at the money strike. Okay, so just remember that thing. So what is theta? Theta is very important. Theta is most important option Greek. Okay, so theta refers to change of decline in the value of option over time. I repeat, theta refers to change of decline in value of option over time. That means, for example, imagine today is Monday, and if you look at the option price, if you look at the premium price, which is at 80, if you look at the same strike, then the premium will be. I mean, if you look at the same strike and the same premium tomorrow on Tuesday, that will decrease. That's because of theta. Wait, I will explain you with an example. See, look at 14,150 premium. It's 80, right? Okay. So tomorrow, if you check the premium of, if you check the premium, it will be decrease. I mean, you will see that it will be around some 60 or 64. Okay. That's because theta is nothing but uh, change of decline in the value of option over time. It's nothing but it's like charges that you need to be paying. Okay, wait, I'll be explaining this with an example. Okay, imagine about your taxes. Okay, so imagine that you are doing an IT job and you are getting some 60K. Okay, So you won't get 60K. You won't get 60K in hand salary. Okay. You there will be having some deductions. Okay. In the similar way, option premium will be decreasing. Okay. Option premium will decrease in time. For example, to on Monday, if option premium is 80, on Tuesday it will be 64. Okay. Imagine that there is no movement in Nifty. Just imagine that there is no movement in Nifty. Imagine that Nifty stayed at 14,150 on Monday, Tuesday, Wednesday, Thursday. Okay. For that, option premium, what's option premium? Option premium is 80 rupees here now on Monday. Imagine that option premium is 80 on Monday. So if Nifty is not moving also, that premium will become 64 on Tuesday and some 40 on Wednesday, and it will become 0 on Thursday, because Thursday is weekly expiry. Okay, I repeat, just imagine that Nifty is not moving. Okay, it just struck. Okay, in that scenario, even though Nifty is not moving, the premiums will expire on Thursday. Okay, so imagine that if some premium is 80 on Monday, it will become 64 or around 60 on Tuesday, and it will become around 35 or 40 on Wednesday, and it will become 0 on Thursday, because Thursday is an expiry day. So the I mean, you can ask me why the premium is decreasing when there is no movement in Nifty. Okay, this happens because of theta. Theta has a negative effect on option premiums. Okay, now see what I talked about delta. If delta is high, premium will move, premium will increase. If delta is low, premium will increase only less. Okay, so theta is nothing but it's like a charge that you need to be paying. Okay, theta is nothing but it's time decay. Okay, so imagine that you have bought Fortuner car. Okay, so the value of car today is some, imagine that the value of the car today is 25 lakh. Okay, so the same, I mean the imagine that the value of the same car, what will be the value of the same car after 10 years? What will happen? The value of the car will decrease, right? Exactly. That's what happens in option Greeks as well. That's what happens with option premium as well. Okay, the value of the premium will decrease when you move forward to expiry, when days are coming close to expiry. Okay, I repeat, imagine that you have bought a car, Fortuner car, for 25 lakh. Okay, so the value of the car will decrease if you move up next 10. For example, imagine that you are in 2010 and you bought a Fortuner car at 25 lakh. So what will be the value of that car in 2020? Imagine that you have bought Fortuner car in 2020 and you want to sell that car in 2030. Okay, so obviously the value won't be 25 lakh, it will be decreased. Okay, that's time decay. Similarly, when it comes to options, when it comes to option premium, there will be time decay here as well, and that time decay can be called as theta, which is nothing but the value of the premiums will decrease in time. Okay, on Monday, price will be around 80. On Tuesday, it will be around 60. On Wednesday, it will be around 40 or 35. And on Thursday, it will expire 0. It will come down to 0 if there is no movement in Nifty or underlying asset. Okay. So the best I can explain is about a Fortuner scenario. Okay. Just imagine that you have bought Jaguar or some BMW today and you want to sell the same car after 10 years. What will happen? Obviously, the value of the car will decrease and you will get less money. In the similar way, similarly in option Greeks as well, when it comes to option contracts, when it comes to option premiums, the value of the premiums will decrease in time. Okay, when they are coming to expiry, when they are closer to expiry, the value, their value will decrease in time. Okay, so the premiums will decrease from 80 or some thousand, and they come to 0 on expiry day. Okay, not all options expire, only out of the money options expire. Okay, so all right, you will get all those details, you will get to know everything about option out of the money expiries and lot many things in upcoming sessions. Okay, so just remember that the value of Fortuner decreases in 2030. Okay, if today it's 25 lakh, definitely it will decrease in 2030. Okay, in the similar way, option premiums will also decrease when they are coming closer to expiry. Okay, so that effect is called time decay effect, which is also called as theta effect. Theta effect. Okay, so theta refers to change of decline in the value of option over time. Okay, so if all variables are constant, that's what I told. Imagine that Nifty or Bank Nifty or some underlying asset is not moving. So if all other variables are constant and option lose value as its time draws closer to its maturity or expiry. Just what that's what I told, right? When options are moving close to expiry, their premiums will come down to zero because of time decay effect, because of theta effect. Okay, so theta is usually expressed as negative number. It indicates how much the option premium can decay every minute up to maturity or expiry. I repeat, theta is usually expressed as negative number. Yeah, the value of Fortuner car is 25 lakh today. It will definitely come. I mean, it will definitely come down to 23 next year, and it will definitely come to 21 in 2024. It will come down to 17 or 16 lakh in 2025 or 27. That's how the value of the Fortuner will decrease. Okay. In the similar way, the value of the premiums will also decrease when they're coming closer to expiry. Okay, so theta is nothing but it's usually it is expressed as a negative number. It indicates how much the option premium can decay every minute up to expiry, up to maturity. Okay, so you just remember Fortuner example, and you just keep in mind that option premiums, I mean, the value of the option premiums will decrease in time. The value of the option premiums will decrease in time. Okay. On Monday, you will see some value of option. On Monday, imagine that if you saw the value of some premium is around 80, then it will come down to 60. And then on Wednesday, it will come down to 40 and it will expire zero if it's out of money. Okay. Out of the money option. You'll get to know more about theta in upcoming sessions. Okay, when we talk about strategies, I'm gonna talk about theta, more about theta. Okay, so yeah, look at this slide. Theta is more powerful when it's closer to expiry. Okay, and let's look at theta decay graph. So Friday, there won't be any theta decay on Friday, and when compared to Friday, there will be more theta. There will be more time decay on Monday, and when compared to Monday, there will be more time decay on Tuesday, and compared to Tuesday, there will be more time decay on Wednesday, and compared to Wednesday, there will be more time, even more time decay on Thursday. Okay, because Thursday is weekly expiry. That's what I told. When options are moving close to expiry, I mean, when they will expire. When option premiums are moving close to expiry, time decay happens faster. I repeat, when option premiums are moving close to expiry, time decay happens faster. Okay. On Friday, there won't be any time decay. Monday, there will be some. Tuesday, there will be little more. Wednesday, there will be even more when compared to Tuesday. On Thursday, massive time decay happens. Okay. Because all out of the money uh, options will expire to zero on Thursday because Thursday is weekly expiry. Okay. So theta can be defined as a price that cuts off from the premium depending upon the time. That's what I told. Theta is nothing but time decay. Time decay happens more when it's closer to expiry, and it's like the value of the Fortuner decreases. Similarly, the value of the premiums will also decrease when they are coming closer to expiry. Okay, so note, very important point. All out of the money strikes come to zero on expiry. Okay, that's very important point. All out of the money strikes expire to, I mean, come to zero on expiry day on Thursday. And remember, time decay happens more when options are coming closer to expiry. On Thursday, there will be massive time decay. Okay, the theta will be more powerful on Thursday. So on Friday there will be less. I mean, no time decay. On Monday there will be less. On Tuesday there will be little more, little. On Wednesday it will be more. On Thursday there will be massive time decay. So this is the, I mean, that that line says the powerfulness of theta on different days. Okay, so all out of the money strike expires to zero on expiry day on Thursday, which is nothing but Thursday. Okay, so all right, let's look at theta. Look at the value of theta. It's just minus 13, right? It's just minus 14. It's a negative number. So if delta and gamma are trying to increase the value of premiums, theta will try to decrease the value of the premium. Okay, now see, for this strike, premium is 80, delta is 0.49, and gamma is 0.0019. And look at the theta is minus 13.74. Okay, so when these two are trying to increase the value of premium, theta will try to decrease the value of the premium. When they are closer to expiry, this minus 13 can become to minus 40, 80, 120. Okay, look at the value of theta. It's just minus 13 here. If it's Tuesday, it will be more. If it's Wednesday, the value of the theta will be even more. If it is Thursday, then this value will be around minus 80, 90, 70. Okay, just open Quants app and select chain from left banner, select chain, then you will see everything here, all about option Greeks. Okay, so this theta value will varies when it is, this will become more, the value of the theta will increase, and the value of the theta will become more powerful when it is coming closer to expiry, which is nothing but Thursday. Okay, so what is Vega? Simple. Vega is an option Greek that measures an option sensitivity to implied volatility. Okay, so Vega is an option Greek that measures an option sensitivity to implied volatility. Oh, Vega is, it is a change in the price of the premium for a point change in the implied volatility. Just ignore all these definitions. Okay, I'll be explaining about Vega in very simple words. Okay, so Vega determines with what speed can an option move. Okay, just remember this line. Vega determines, Vega V for volatility. Okay, Vega V for volatility. I mean, implied IV is implied volatility. Vega is also volatility. Okay, all are similar. Okay, Vega determines with what speed can an option move. Okay, so small value of Vega employs sideway market. High value of Vega employs bullish or bearish market. Let's look at value of VIX. See, this is India VIX. India VIX is nothing but volatility. It tells that with how much speed Indian markets can move, which is nothing but volatility. People also call it as implied volatility, or in option Greek, they call it as Vega. Okay, so it's pretty similar. If the value of Vega is high, that means the market will move with high speed towards upward or towards downward. If the value of the VIX is less, then that means market will move in sideways. Look at the value of Vega. It's 20.03. I mean, VIX. This is the value of VIX. See, there is a rise in VIX from 1045. Let's look at Nifty. Or Bank Nifty? What happened around 1045? Okay. $10.45. See, drastic movement in the Bank Nifty. Okay, so that can happen if VIX rises. That can happen if VIX rises. Let's look at Nifty. See, drastic fall. That's why that happened, because there was a spike in Vega. Okay, so if VIX increases, market will be more volatile. It will move. It will make strong movements towards upside or downside. Okay, if India VIX is less, market will move in sideways. Okay, so just remember that thing. And this VIX should be less than 24 or 23 for a sideway market, and this VIX should be If India VIX is more than 24 or 25, that means the market will be more volatile. Okay. So that's all about Vega. Vega is nothing but Vega determines with what speed can an option move. Small value of Vega implies sideways market, and high value of Vega implies bullish market or bearish market. That means if the value of VIX is high, that means market will move strong movements towards upside or downwards. Okay. So if the value of Indian VIX or Vega is small, that means market will move in sideways. Okay. So it is a change in the options price for 1 point change in implied volatility. Just ignore. So traders usually refers to volatility without the decimal point. Okay. Nothing but let's look at India VIX here. It's 20.03, but people only consider that VIX as 20.00. Okay. We just ignore that decimal points. Most of the traders uh, consider VIX to nearest integer. They ignore the decimal points. So that's what I have written here. Traders usually refer to volatility without the decimal point. They just consider Vega for round. I mean for integers. They just ignore the decimal points. If it's 20 point, imagine that it's 22.33. Then people say that VIX is 22. They just ignore 0.33. If VIX is 25.66, then people say that VIX is 25 and they ignore 0.66, which is decimal point. Okay. So traders usually refer to volatility without the decimal point. And whereas Vega is the sensitivity of a particular option to change in implied volatility, not nothing much. Okay. So I already told Vega is volatility is also called as implied volatility. Okay. So just remember one thing about Vega. Vega is nothing but it determines with what speed can an option move. Okay. If Vega is small, sideway market. If Vega is high, bullish or bearish market. Market will make strong movements towards upside or downside if Vega is high or VIX is high. If VIX is low, market will move in sideway market. I mean, market moves sideways. Okay. So here is a practical example of Vega. If volatility is 10%, when Nifty is at 100, then Nifty can move minus 10% to plus 10% that day. I repeat, if volatility is 10%, when Nifty is at 100, then Nifty can move minus 10% to plus 10% that day. Okay. Imagine Nifty can move till 90 or it can move till 110. Now see, Nifty is at, imagine that today Nifty is at 100 rupees. Okay. And imagine that volatility is 10%. Okay. So what can happen on that day? That means Nifty can make, I mean, it can move minus 10% to plus 10% that day. That means Nifty can move till 90 from 100 or it can move till 110 from 100. Okay. So if it's 10%, then it can make 10% towards positive side or 10% towards negative side. Okay. So it can move till 90 or it can move till 110 that day. Okay. So Vega determines with what speed can an option move. That's a very important point that, I mean, that's what you need to remember about Vega, and you need to think about this example. So when Nifty is at 100 and when volatility or VIX or some implied volatility says 10%, then that means Nifty can move 10% towards negative side or 10% towards positive side. That means Nifty can move to 90 or it can move to 110. Okay, when volatility is 10%. That's all about Vega. Let's look at Vega in Quantsap. So look at Vega. It's 5.12 here. Okay, so it's 4 point. For this strike, it's 4.46. For this strike, it's 3 point. So I mean, this strike price will move less with less speed when compared to this strike price premium. Okay, let's look at this strike price. Look at this strike price, 222. I mean, the strike price of 139.50. Okay, so it's, I mean, the premium is 27.5. This is put side. Okay, this is call side. Okay, so imagine that I have selected 13,950 put. What's the premium? It's 27.50. Look at theta. Sorry, look at Vega. It's 3.63. Okay, let's look at the money strikes Vega. It's 5.16. Okay, So this premium moves more faster than this premium because Vega is higher for at the money strike and Vega is lower for out of the money put strike. Okay, so if Vega is less, that means this premium moves with less speed. Here Vega is high, that means this premium moves with high speed. Okay, that's all you need to remember when you think about Vega. Okay, so what is rho? We can actually ignore rho because we don't consider rho while trading. Okay, I'll just go through the definition. So rho is a measure of option sensitivity to interest rate changes. This is more related about bank security. This is more related to bank securities and many more other details. So we don't want to we actually don't need about rho. Okay, so interest rate are used in pricing models to take into consideration an options price based on its hedged value. The idea that an investor uses long or short stock to hedging is nothing but risk management of option positions. Okay, so that's the definition of rho. uh, it's fine if you ignore rho or definition of rho. If you don't understand rho also, no worries, because it's not really important. Because it's part of option Greek, I had to put this slide. It's actually not necessary to think about or to know about rho. Okay, so what's an expiry in options? You already know what's an expiry. Okay, here is a formal definition of expiry. An, an expiration date in derivatives is the last day that derivative contracts, such as options or futures, are valid. Okay, I repeat, an expiration day is an expiration day in derivatives is the last day the derivative contracts, such as options and futures, are valid. Okay, so before an option expires, its owners can choose to exercise the option or close the option to realize their profit. Okay, to release the profits and losses and let the contract expire worthless. Okay, what's an expiry? Formal weekly expiry is Thursday and monthly expiry is month's last Thursday. Okay, so expiry is nothing but there will, if there is a derivative, then there will be definitely an expiry day for the derivative. Okay, so an expiry is nothing but it's the last day that option contract or derivative contract will expire. So after expiry, there won't be any value for the derivative or option contract. Okay, so before an option expires, the owner is nothing but the one who is making an option contract by paying the premium. Okay, so they will get the right if they pay the premium. Okay, so that owner can have three chances. He can exercise the option, he can close the position, or he can lapse the option. Okay, so you already know what is exercising the option, lapsing the option. I have explained about lapsing the option, exercising the option in our previous session. Okay, so I hope you guys remember it. Okay, if you have any doubts, you can watch that session again, or you can message me. I'll be replying. I'll be explaining you about lapsing and exercising the options. Okay, so the one who enters option contract by paying the premium, he'll get the right. If he's having the right, he'll have three chances. He can exercise the option, he can lapse the option, or he can close the position. It depends upon how much profit he needs. Okay, so that's all about expiry. And look, this slide is important. Index options expiry. So weekly expiry is on every Thursday and monthly expiry is on month's last Thursday. If last Thursday is holiday, then options will expire on Wednesday. I repeat. So this is index options expiry. So there will be weekly expiry and monthly expiry for indices. So weekly expiry is on every Thursday and monthly expiry is on month's last Thursday. If month's last Thursday is on holiday, then contracts will expire on previous working day, which is nothing but Wednesday. If Wednesday is also holiday, then contracts will expire on Tuesday. It's like that. Okay. So stock options expiry. So there will be different expiries for stocks and also for indices. For index, there will be weekly expiry and monthly expiry, and weekly expiry is on Thursday and monthly expiry is on month's last Thursday. Okay. For stocks, monthly expiry is on month's last Thursday. That's same, but stock options don't have weekly expiry. This is very important point you guys need to remember. Okay. If you are trade if you want to trade on expiries for every week, then you need to be trading on index only, because stock options don't have weekly contracts or weekly expiries. I repeat, stock options don't have weekly expiries. If you want to trade on stock options, then you need to be choosing monthly expiries only, and monthly expiries for stock options is on last Thursday of that month. Okay. So, but in this indices, nothing but Nifty and Bank Nifty will have weekly expiry and also monthly expiry. Okay. So weekly expiry is on Thursday and monthly expiry is on month's last Thursday. Okay. So if Thursday is an holiday, then expiry will be on previous working day, which is Wednesday. Okay. Important point is stock options don't have weekly expiries. So if you want to trade on weekly expiries, then you need to trade on index options, which is nothing but Nifty and Bank Nifty. Okay. So market outlook to calls and puts. You guys already know this. CE is nothing but call European. PE is nothing but put European. We trade European style. Okay. CA is nothing but call American. PA is nothing but put American. That's American style of trading. CE is nothing but call European. PE is nothing but put European. This is European style of trading. We follow European style. So call option is represented as CE and put option is represented as PE. Okay. And one more important thing is, I mean, in European style, in Europe and in India, weekly expiry is on Thursday and monthly expiry is on month's last Thursday. Okay. But in America, weekly expiry is on Friday and monthly expiry is on month's last Friday. I repeat, in Europe, if we follow European, I mean, we are following European style. So call option is represented as CE and put option is represented as PE. Okay. So in this style, in European style, weekly expiry is Thursday and monthly expiry is month's last Thursday. Okay. But when it comes to CA and PA, which is nothing but put American and call American, nothing but American expiries are little different. Okay. So their option contracts expires on, I mean, if it's weekly expiry, then it will be on Friday. And if it's monthly expiry, then it will be on month's last Friday. Okay. That's for Americans. They follow American style. We follow European style. So our expiry is on Thursday and monthly expiry is on month's last Thursday. Okay. So, oh my God, I have written this. I thought I forgot. So call up USA style of trading option. Okay. So call option is represented as CA and put option is represented as PA. Ignore. Okay. There is a mistake here. Okay. So, okay, there is mistake in this slide. So in American style, call option is represented as CA and put option is represented as PA. Okay. So in USA, weekly expiry is on Friday and monthly expiry is on month's last Friday. You guys know that. All right. That's all about option Greeks. So now you know what is delta, what is theta, what is gamma, what is vega. Okay, vega is nothing but it tells that with what speed the premium can move. Okay, delta is nothing but if delta is 0.30, that means premium will move 30 points when underlying asset Nifty or Bank Nifty moves 100 points. Okay, I repeat, when delta is 0.70, that means premium will move 70 points when its underlying asset Nifty or Bank Nifty moves 100 points. Okay, that's all about delta. Gamma is nothing but it determines change in, it says, I mean, it says, or it's nothing but it affects change in 1 point movement in delta. Okay, So just like how delta is affecting premium, in the same way, gamma will affect change in delta. Okay, so they're interdependent. That's it. And the value of the gamma is high for at the money strikes, and the value of the gamma will be less for in the money and out of the money strikes. Okay, so that's all about gamma. And coming to theta, theta is nothing but time decay. Remember fortunate example, the value of the car decreases in 2030 if you go down to 2030. Okay, in the similar way, value of the premiums or value of the option contracts will expire. I mean, when option premiums and options, when option premiums and option contracts are coming closer to expiry, uh, their value will decrease. Okay, so the option premiums will expire to zero. Out of the money options, option contracts will expire to zero on Thursday on weekly expiry. Okay, so nothing but their value. I mean, the value of their premiums will decrease when they come closer to expiry. Okay, it's nothing but time decay. So that happens in option contracts as well, and we refer time decay as theta here. So that's all about theta. And coming to volatility, you already know volatility. If it's 10%, that means Nifty can make 10% downward, and or Nifty can move 10% downward or 10% upward. If it's 3%, then that means Nifty can move 3% upward or 3% downward. That's all about Vega or implied volatility or India VIX. Okay, so if if VIX is less, then market will be sideways. If VIX is high, then that means market will be making strong movements towards upward or downward. Okay, so that's all you need to remember about option Greeks. And where do you see the value of option Greeks? Simple, go to Google, type in Quants app, select first link, just log in to Quants app, and click on top left banner, come down and click on chain. You'll see the, wait, I'll show you. Yeah, this is the top left banner, and you need to click on this chain. Okay, after clicking on that, you'll get this layout, and you'll be able to see delta, theta, vega, and gamma for each and every strike. Okay, so you need to analyze the values of all these things before choosing the strikes, and also you need to look at how far you're from the expiry. Okay, like I told, the value of the theta will be more when it's closer to expiry. Theta will be more powerful on Thursday. Okay, so, and I also told you that all the out of the money strikes will expire to zero on Thursday. Okay, so try to choose out of the money strikes if it's expiry day, if it's Thursday. Okay, that's the advice. And I'm expecting that you guys are pretty clear with what is option Greek and what are different types of option Greeks, and what is delta, what is gamma, what is theta, and what is vega, and what is American expiry and what is European style expiry, and why do we call it CE and PE, etc. Okay, so I hope you guys are pretty clear with what all with taught till now. So if you guys have any questions, call me up or message me anytime. I'll be explaining you. Okay, so please like this video and subscribe to our YouTube channel. Thank you guys. Thanks a lot. Thank you everyone.